Most couples think IRA contributions are off limits if one spouse doesn't earn a paycheck, and that's simply not true. The so-called spousal IRA lets a couple use the working spouse's income to fund the IRA for the non-working spouse, effectively doubling how much they can stash away in a given year. In 2025, that can mean thousands of extra dollars compounding for decades if you follow the rules and avoid a few simple traps. Before we dive in, my name's Ryan Knoll. I'm a certified financial planner and founder of NavWealth Partners, a financial planning firm that helps clients nationwide make smart money decisions. Let's get started. Now, a spousal IRA isn't a special type of an account. It's just an IRA, and it can be traditional or Roth, and it's opened in the non-working spouse's name, but funded by the working spouse's earnings. The key requirements are you must file a married filing jointly tax return, and the working spouse's earned income must at least equal the combined IRA contributions for both spouses. Each spouse still gets their own IRA and their own annual limit. You're just borrowing the earnings record of the working spouse. And for 2025, the IRA contribution limit is $7,000 per person, and you get an extra $1,000 if you're over the age of 50. So up to $8,000 each in that instance. That means a couple can put away between $14,000 and $16,000 depending on their age, and you can still make those contributions until the tax filing deadline in April of 2026. And a quick but important note is that thanks to the Secure Act, there's no upper age limit to make traditional IRA contributions as long as there's earned income. So a retired spouse who picks up part-time work at 72 can still contribute, and the non-working spouse can contribute on that as well, via that spousal rule. Again, subject to the joint filing and compensation tests. So you do have the option of picking either traditional or Roth. You're not specifically pushed towards one or the other under the spousal IRA loophole, but the eligibility math differs for each. So for the Roth IRAs in 2025, married couples filing jointly can make full Roth contributions if their modified adjusted gross income is under $236,000. A partial contribution will be allowed between $236,000 and $246,000, and above $246,000, you would not be able to make a direct Roth contribution. Singles, that phases out between $150,000 and $165,000. Now, under traditional IRAs, we're looking for deductibility rules, and anyone with sufficient compensation can contribute to a traditional IRA, but whether that contribution is deductible depends on the workplace plan coverage and income of the couple. For 2025, if the contributing spouse is covered by a workplace plan, the traditional IRA deduction phases out for married filing jointly between $126,000 and $146,000. If you're not covered but your spouse is, the deduction phases out much higher between $236,000 and $246,000. And singles covered by a plan, that phases out between $79,000 and $89,000. Put differently, a non-working spouse can often fully deduct a traditional IRA contribution even when the working spouse can't, because the non-covered spouse uses the higher spousal phase-out range. And if you find yourself making non-deductible traditional IRA contributions, you can still utilize the backdoor Roth IRA loophole on top of this. Just be aware of your overall IRA picture and whether you have contributions that are both deductible and non-deductible. If you have both, you may trigger the pro rata rule, which could negate any benefit that you would receive. Now, just remember there's 3 rules that couples must nail when it comes to the spousal IRA loophole. The first one is, again, to file jointly. No joint return, there's no spousal IRA. Married filing separately is severely limited. Roth phases out between $0 and $10,000. Most couples earn more than that, so you can't make that direct Roth contribution. The second rule is to have enough earned income. The working spouse's taxable income must be at least the sum of both spouses' IRA contributions for that year. And third, you want to make sure you know the income limits. For Roths, watch the modified adjusted gross income thresholds. And for traditional IRAs, decide whether you want a deduction and whether you're covered by a plan at work. Let's go over a few examples to illustrate how this works. First, we're going to go over the mid-career couple who's maximizing the Roth contributions. We have Jordan, who's earning $180,000, and Taylor stays home with their kids. Married filing jointly, their modified adjusted gross income for 2025 is under the threshold of $236,000. They can each contribute $7,000 to their own Roth IRAs, or $14,000 total for 2025, using only Jordan's earned income to meet the compensation test. That's the spousal Roth in action. And why do we like this? Well, that's 2 tax-free buckets growing simultaneously with flexibility later on within their retirement plan, and there's no forced required minimum distributions during their lifetime. This next example is going to cover one spouse who's covered at work and the other one who isn't. And Avery earns $140,000 and participates in a 401k. Casey doesn't work, filing jointly with a modified adjusted gross income of $140,000 total. Avery's traditional IRA deduction phases out between $126,000 and $146,000, so they might get a partial deduction or consider Roth depending on their bracket and future tax outlook. Casey, on the other hand, the non-covered spouse in this situation, could still be fully deductible because the spousal phase-out range is much higher. That's $236,000 to $246,000, and they're well below that. So the net effect here is that even when the covered spouse loses a deduction, the non-working spouse may still get one. This could lower the taxes that they owe for the given year and even give them a bigger refund, which can be very important for couples on a single income. In this next example, we have a high-income couple above the Roth IRA limits. Priya earns $300,000. Sam doesn't work. They want Roths, but they exceed the $246,000 married filing jointly cap. This is where the backdoor Roth IRA would come into play. Each spouse makes a non-deductible traditional IRA contribution. Each spouse then immediately converts that contribution to a Roth IRA, and they file a Form 8606 with the IRS for each spouse to track basis and conversions. You want to be aware of the pro rata rule here. If either has pre-tax IRA balances, consider rolling those into a 401k first to avoid muddying the conversion. Yes, the spousal IRA rule helps here. Both spouses can execute their own backdoor Roths, even if only one earns income, as long as they file jointly and meet the compensation test. And this is one of the ultimate cheat codes for couples who earn over the phase-out. Doing a contribution of $14,000 a year over 20 years and earning 8% on that money will give them close to $640,000 tax-free in retirement should they need it. One of the trickiest parts of all this is how you coordinate this with workplace plans. If the working spouse is already maxing out a 401k, a spousal IRA can be the next best tax advantage bucket. In 2025, 401k deferrals cap at $23,500 plus catch-ups if you're over the age of 50, and the IRA limit is still between $7,000 and $8,000, again depending on your age. And that's per spouse. That's powerful layering and diversification across pre-tax, Roth, and taxable accounts. You could also look to increase deferrals in the workplace plans in order to make sure they fall under the income phase-outs for whether it's a traditional IRA or Roth. That could allow you even more tax savings or access to Roth contributions that you would not otherwise be eligible for without some diligent planning. Now we're going to go over a practical checklist and some pitfalls that you should keep in mind for this year. So first, you want to pick the account types. If your modified adjusted gross income this year is under $236,000, consider prioritizing Roth for both spouses. If you expect a high current bracket but lower future bracket, a traditional deduction, where allowed, could make sense. You want to verify your compensation next. Make sure the working spouse's W-2 or self-employment income is enough to cover both contributions. You also want to set the right contribution amount, $7,000 each or $8,000 if you're over 50. Automate this monthly if cash flow is uneven. You also want to keep in mind the deadline. You generally have until April 15th of 2026 to make or top off 2025 contributions. Designate the tax year with the custodian. Above the Roth limits, you want to utilize your backdoor Roth, but clean up pre-tax balances first and file a Form 8606 correctly. Let's move to some of the pitfalls. Married filing separately. That status will crush your Roth eligibility because the phase-out stops at $10,000 of earned income, and that complicates deductibility even more. If you're over-contributing, you want to make sure that you correct it before you file to avoid the 6% excise tax on the excess each year it remains in there. Your custodian can help you remove the excess and related earnings. You also want to make sure you're not ignoring deductibility. Contributing is easy. Deducting is not guaranteed if the covered spouse's income crosses a threshold. Check the 2025 phase-outs before claiming a deduction. And finally, don't forget about your catch-ups. If either spouse is over the age of 50, leave the extra $1,000 in the account so you don't leave it on the table. So why does this loophole matter? The spousal IRA effectively doubles your IRA runway. Over 20 to 30 years, adding an extra $7,000 or $8,000 per year, especially to Roth if you qualify, can be the difference between a tight retirement and a flexible one. It also balances ownership. Each spouse accumulates assets in their own name, which can simplify beneficiary planning and withdrawal strategies later on. The bottom line here is if one spouse isn't earning in 2025, don't assume your IRA opportunities are limited. File jointly, meet the compensation test, and then choose Roth or traditional based on your tax picture and consider the backdoor Roth if your income is too high. The spousal IRA is one of the cleanest ways to turn a single paycheck into 2 long-term retirement buckets without waiting for a second job to show up. If you want help deciding which mix, Roth, traditional, or backdoor, fits your 2025 tax picture, that's exactly what we do here at NavWealth Partners. See you in the next video.